Welcome, my friends, to another edition of the Heritage Wealth Planning YouTube channel. Today, I want to follow up on the conversation I had yesterday, or I guess just a few minutes ago, on the Dave Ramsey video where he talked about if you had $1 million, you could take $70,000 a year out without really worrying about even tapping the principal, never mind running out of money. And I took issue with that as well. You should too, by showing you the Vanguard piece right here. Let me move myself out of the way. There we go. Let me get my there we go. But the Vanguard piece that shows you that the average returns of 10%, you don't get that in any given year. You don't, not even close. In fact, in the stock market, while the average return might be 10, only 6% of the time are you getting anywhere between 8 and 12, going back to 1926. All right. And even the bond market, Vanguard talks about the bond market too. And even the bond market, where the average bond return is 5.35, you're only getting between 3 and 7.35 about 20 to 30% of the time. So the stocks and again, those are huge corridors, by the way. And we're talking gigantic variability in bonds going from 3 to 7 and stocks going from 8 to 12, just to get the average of 5 in the bonds and 10 in the stocks, respectively. So I just want to share with you this. I've been looking for this, a couple firms. In fact, this one that kept, you can't see that, and I'm not going to use this, is the Hartford. They had I'm not sure when this was, from 2006. I've kept this since 2006. Probably ought to throw it away. But they had a sequence of return risk chart. American funds had all these, BlackRock, American funds, all these guys have a sequence of return chart to show you the risk that I'm telling you about that Vanguard shows you right here. Stock market up, down, 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 up, down, 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 up, everything but average. And what Dave Ramsey and all those people who follow that advice, unfortunately, are mistaking is that average is an anomaly. You don't get average. You get anything but average. So if you're pulling out a significant amount of money a year based on averages, you're going to run out of money. If you're unlucky. Now, you might be lucky and have a gazillion dollars at when you die. But we're not trying to plan for you to be lucky in order to have a gazillion dollars. We're trying to avoid you from eating ramen noodles and going to your kid's home and saying, I need to live in with you because I can't afford rent. So let me show you what these guys did. This is probably the best half-hour research. This is probably the best chart I came up with. I was really looking for the American funds one because they did one that similar to this, which I like quite a bit. This one's still pretty good. Pension Consultants Inc. What do I do now when the market return drops quite a bit? So they have the sequence of returns comparison. What they're saying is the chart entitled Sequence of Return Comparison demonstrates, it shows a $1 million portfolio with $50,000 a year being withdrawn for income, indexed for inflation. So you get $1 million portfolio with only pulling 5% a year out. That's it. Only pulling 5% a year out. And remember, old Dave, let me move this out of the way, say we can pull 7% a year out without even tapping into principal. Well, here's the real world numbers. If you retired in 1989, your $1 million, and again, we're pulling 5% a year out, adjusted for inflation each and every year. So we're pulling more each and every year. If you retired in 1989, look at that. You got 1.26. It goes down a little bit, goes up, goes up, goes up, goes up to $5 million, my friends, in 1999. So you've pulled well over $500,000 out. You started with only $1 million, and you got $5 million at the end of 1999. You got hammered in 2000, hammered again in 2001, hammered again in 2002. So you're down, was that 40%? But you still took another probably by then about $200,000 out for income. And again, you're going back up 2008. So 2007, again, you were back up to $5 million after taking $50,000 a year, adjust each year for inflation. You got hammered in 2008, so you're only down to $3 million. Oh, whoop-de-doo. Sorry, you're only down to $3 million. You took 20 years at $50,000 a pop. I'm not even accounting for inflation. That's you took $1 million out without even accounting for inflation, whatever the inflation was. Probably $1.5 million out. You start with $1 million, you got $3 million to show for it after the worst year we've had since the Great Depression. Jeez, ain't too shabby. And then on top of it, where you are today, that $3 million is probably up to $7 million right now, just because the markets have been on a nice little tear. So you've done quite well. Now, on the other hand, let's say we just reverse the numbers and say we reversed when you retire. So you didn't retire the returns you got were reversed from this. 37 here, 37 up there, 5.49, 5.49. So we'll just say we pretended we retired in 1989, but we got the market returns from 2008, 2007, 2006, 2005, and so on. That makes sense? So we're just flipping it over. We're saying we got the returns of the same exact years from 1989 to 2008, but instead of getting the returns like we did this time, we got the returns just inverted. We got them on the just what was Z is now A. What was A is Z. Okay. So in 2008, we were down 37%. So we took 50,000 out of our portfolio. We're down 37%, and we're left with 580. 2007, and you can see 2006, all the way down till we ran out of money in 1991. So we didn't have the portfolio for 20 years before we ran out of money. We averaged 10.36, as did this guy over here average 10.36. Is this guy stupid? Is this guy a moron? Is this guy evil? Nope. He's just bad luck. Bad luck. Is this guy brilliant? Is this guy Warren Buffett? Is this guy the second coming? Good luck. It's just that simple. Good luck, $3 million after 20 years. Bad luck, he ran out of money after 18 years. Nothing else changed. The average return is still 10.36. The only thing was I got hit on the front end of my retirement with bad years. Even he got hit on the second year of retirement with a bad year, a down year. It wasn't horrific, but it's still down. But because he didn't get hit like this guy did, he made money, big bucks. I got smacked around the first couple of years of retirement, the first year of retirement, and I'm doomed. I will never recover. Because remember this, what was a 5% year withdrawal is now we're taking 50,000 on 560. That's a 9%. Yeah, 8.9%. We're taking 50,000 on 560. This guy's still at a 50%, 5%, well under 5% threshold. And that's where the sequence of return risk can really come to haunt you. It has nothing to do with who you are, your investment prowess, nothing. It has solely to do with risk and the luck that you have. No getting around it. And it's sad, but that's why we can't pay attention when people like Dave say you can take a certain amount out without even touching the principal. Because remember, he's saying you can't. This guy, the bad luck guy, is taking only 5% a year out. Dave's saying he can take 7%. Without even touching the principal means your $1 million is still there. It's not true. This guy's down to 580 after 1 year. He definitely touched the principal. He never even comes close to get back to $1 million. Not even close. So anyway, I just want to kind of wrap that bow up because it annoys me, and I think people are falling for that. It's just horrible advice. Now, what happens is, look, in 1989, when the market was up 31%, he had no money left to take advantage of it. He was run out. He just had no money left. So the first 2 years are so critically important. So critically important. What I tell folks, I say it all the time. I have no mathematical PhD to back this up. Don't care. I say have enough to cover your first 2 years of retirement in cash. That way, we don't need to pull money out of the markets when it's down that 37% or conversely down 22, 11, and 9 respectively. We don't need to touch it when it's down. Have 2 years of cash. Ideally, if you always have 2 years of cash, just always 2 years sitting there. So you had spent it a year, let's say, of an up of the market, and you spent some of that cash last year, pull some out, put it in cash. Have cash for 2 years. That way, when the markets fall off a cliff, which they assuredly will, you do not need to take 9% a year out of the market because you'll never recover from that. You never will. So 2 years in cash, the next 3 to 5, even 3 to 7 in intermediate bonds, maybe some long-term bonds, that's fine. Anything above 7 years, we want in equity stocks to get growth. We do not want to touch the stuff that is 7 years out, the stocks. We don't want to touch those when the markets are falling off a cliff. Now, with that said, bonds can still fall. Don't get me wrong. So if we're running out of money and we need to have access to something and the bond market's down and stock market's up, well, don't be stupid. I mean, take the thing that's up, which is the stocks. You can do this. It's not rocket science, my friends. You just have 2 years of cash to draw on as the markets go up and down. You have some bond portfolio to cover the next 3 to 5 to 6 years. That way, when the markets do start tanking or going up, or if the cash starts dwindling, you can tap into that. Now, if the markets don't look favorably for the bonds, we take it from the stocks. My goodness, this isn't rocket science. It's just a strategy. And strategies work as long as you stay the course. Have to have stocks. You need to have cash. Whether or not I have bonds is up for debate. I can go on either side of that, but you have to have stocks and need some cash. No two ways around that. So hope this was helpful to you. I just it is a pet peeve of mine. I probably won't talk about this again anytime soon. I probably will because it bothers me. But anyway, if you have any questions, thoughts, concerns, put them in the comments below. As always, give me a thumbs up. Share this stuff with people because I do think somebody with a megaphone as loud as Dave, I think there could be a lot of people that are being misled, and that's not good. And again, he's not doing it deliberately. I almost wonder if there's a little bit of arrogance in there. I'm sure I'm not the first guy, I know for a fact, that's ever said to Dave, "What are you doing, man?" I do wonder if there's a little bit of arrogance in there, not recognizing some bad advice. And I know Dave loves the Lord, but I do think sometimes. No, I don't know. I'll just leave it at that. It's just all right. So anyway, share this with people. Give me a thumbs up. Notes down there in the comment section, please. Don't forget to hit subscribe, and then of course hit the notification bell to be notified of future content. Go to my website at heritagewealthplanning.com. Subscribe to the podcast, the Josh Scanlon podcast, and we'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.